It's been our custom in recent years to add an opportunity to review timely events. And certainly one of the timely events that had us all mesmerized and horrified were the fires of last year. And not only were they significant, but they came much closer to the university than we expected. Literally much closer, affected many of our faculty, staff, and even students. So we thought it would be an interesting opportunity to talk to two people at UC who've done very important work in this area. And I'd like to introduce our speakers, and we have about a half hour with them that I hope will be a bit of a dialogue. So Nancy Wallace is Professor of Finance and Real Estate at the Haas School of Business at Berkeley. Her research focuses on residential house price dynamics, mortgage contract design and pricing, and methods to underwrite energy efficiency in mortgages. She is a past president of American Real Estate and Urban Economics. She has served as visiting scholar at the New York Federal Reserve Bank, the San Francisco Federal Reserve Bank, and has advised the U.S. Treasury Department. Our other guest today is Dave Jones, who directs the Climate Risk Initiative at UC Berkeley's School Center on Law, Energy, and Environment. Jones served as California's Insurance Commissioner from 2011 through 2018. He has led efforts to demonstrate that insurance losses and pricing can benefit from nature-based mitigation strategies. Jones has testified before Congress, state legislatures, and numerous regulatory agencies about the need for financial regulators to understand and address climate change and the risk it poses on the financial system. And Dave provided some handouts which are distributed, a couple on each table, recent press release concerning some new developments. So Dave and Nancy, thank you so much for joining us. Let me ask you first, what led to your interests in California fires and their impact on insurance and real estate?
Would you like to go first, Nancy?
There we go. Dave, can you, not sure we're hearing you.
Are you able to hear me now?
Yes.
Okay, I'll start. So when I was elected insurance commissioner in 2010 and began serving in 2011, my principal focus was on implementing the Affordable Care Act here in California, which we did successfully. But in my second term, as we began to see an increase in severity and frequency of catastrophic fires, killing more people, injuring more people, damaging more homes and businesses, destroying communities, and causing insurers to have to pay out more, my focus shifted. And frankly, it's climate change and climate change driven increased in frequency and severity of extreme weather-related events, which are landing as wildfires, droughts, river floods, coastal floods, hurricanes, tornadoes, severe convective storms, just a partial list. That has been the focus of my work at the Center for Law, Energy, and the Environment, and in particular, what should financial institutions and financial regulators do to address these growing risks associated with growing climate change because of our failure to transition quickly enough from fossil fuels and other greenhouse gas emitting industries. So I guess fundamentally, my interest in this area has been driven by the existential crisis we're facing, which is manifesting itself in various ways, the existential crisis we're facing vis-a-vis climate change.
And Nancy, what about you? Nancy, have we lost you? Oh, different Nancy. Ah, Nancy Wallace. Well, while Zoom is looking for Nancy Wallace, so Dave, take a couple more minutes. What's the way forward? I mean, you're looking at this. What is the way forward, and what can we do as a state, independent or perhaps in the face of opposition from the federal government on some of these initiatives? That'll keep you busy.
Yeah, it will. So I think first diagnosing the source of the problem, which, as I said a moment ago, is global temperature increase causing more severe and frequent weather-related events that are causing more deaths, injuries, damages, and also impacting the financial sector, including significantly the insurance industry. So just to give you a little flavor for that, last year, the insured global natural catastrophe losses were $154 billion, which is a record that exceeded the prior year's record, which exceeded the prior year's record. You see where I'm going. So the insured natural catastrophe losses globally and in the United States are growing over time because we have more of these severe and more frequent weather-related events that are causing these losses. What California is experiencing is not unique to California. This is landing in various ways in various geographies across the United States, whether it's increased severity of hurricanes in the Gulf Atlantic states or increased severe convective storms like atmospheric rivers in the Midwest, New England, and South. Greater number and severity of wind-related events, whether it's tornadoes or hurricanes. Wildfires in the West, right? So the nature of the perils differ, but they're all, to varying extents, getting worse. The way that insurers respond to this is in two ways. One, they increase price, and two, they reduce the amount of insurance they're writing. And insurers are doing that across the United States, not just in California. So there's about 18 states in which insurers are reducing the amount of insurance they're writing or not renewing existing insurance policies. So what do we do about that? Well, one, we need to accelerate the transition away from an economy whose energy source is principally fossil fuels and move out of other greenhouse gas emitting industries for good measure. Hard to do with the federal government moving in the opposite direction, but there are a lot of things the state of California is doing and has been doing in this regard that we need to keep doing and do more of. Two, we need to invest more in adaptation and resilience. In California, what that means is improving homes to better withstand fire, undertaking defensible space to clear areas around the homes from vegetation, and then community and landscape scale investments in mitigation. In the wildfire context, that means ecological forestry, managing our forests in the West the way that nature used to, where fire was a routine part of the ecology of the forest. The fire would burn through, it would burn out low-lying vegetation, it would burn out the smaller trees. Our forests were characterized by a lot more open space and less fuel. And then 160 years of Western settlement, suppression of all fire, genocide against Native American peoples who used to engage in cultural burning, and now our forests are choked with fuel. Well, it turns out that you can mimic how nature used to manage our forests by engaging in controlled fire and thinning, not clear cutting, and removal of low-lying vegetation in forests, which dramatically reduces the likelihood and severity of severe wildfires. So more investments in that. California has appropriated $3.6 billion for that. There was about $5 billion in the bipartisan infrastructure bill for national lands management, some of which is landing in California. Homeowners are encouraged to harden their homes against fire. They're required in some cases to undertake defensible space. Homeowners associations, cities, towns, counties are all taxing their residents to do this sort of mitigation work in various ways. The problem is that the insurance computer models that they use to decide whether to write and renew insurance do not take into account any of what I've just described. They can, technically, in a paper that I published when I was at the Nature Conservancy in 2021, we showed that the computer models, are technically able to account for property, community, and landscape scale mitigation, but they're not doing it. So last week, in a partnership between my center, the Nature Conservancy, and Willis Towers Watson, a global insurance broker, we announced the placement of the first insurance policy whose underwriting was based on landscape scale forest treatment occurring within the 6,500 unit homeowners association located smack in the middle of the forest in the Sierra Nevada. And that's a big deal because it's the first time we've gotten an insurance company to write an insurance policy that takes into account the forest treatment that's occurring in that area. It's a big deal because that insurance company wrote the insurance for that homeowners association because of the forest treatment, where other insurers are pulling out of that area who are not accounting for forest treatment. And then for good measure, the insurance was 39% cheaper and the deductible was 84% less because of the forest treatment. So by placing this product, we've demonstrated that it's possible to do this. Our hope is to encourage insurance companies voluntarily, both standard home insurers as well as commercial insurers and other innovative insurers, to write this kind of insurance policy or take this into the modeling they use for home insurance and business insurance. But if they don't, there's another path the state can pursue, which is to require it. So Colorado just passed a law. I've been working with some folks in Colorado, and they just passed a law that requires the insurers in their state, requires that the models they use to decide how to price and to write insurance to account for property, community, and landscape scale mitigation. So if they won't do it voluntarily, then states are going to need to stand up and require it. This is a path to keep insurance available, making investments in this kind of mitigation at the property, community, and landscape scale, but then making sure that insurers are writing insurance that takes into account is a path to try to keep insurance available in areas that are facing increased risk due to wildfire.
So are our campuses doing what we can do? Are some of our campuses in a more risky environment that is at least partially under their own control?
Well, I can't speak to the risk mitigation or adaptation occurring at particular campuses, although those that are located in forested areas, I would fully expect that the campus leadership is working with the U.S. Forest Service, CAL FIRE, local fire authorities to do everything possible to invest in adaptation and resilience, right? So that's good. But then we're also drawing on the intellectual expertise and research capacity of the various campuses in demonstrating that this sort of adaptation resilience matters and makes a difference and can also be accounted for in insurance modeling. So that's work that I'm doing at the center, but others across the UC system are engaged in various aspects of this work too, which is all to the good. And then there's another aspect of this work, which involves trying to create a public catastrophe model that could be owned by the state, that would in turn be useful to check against the insurer's private proprietary CAT models to make sure that the outputs from those models are what they should be. And so there's another work stream that the Department of Insurance is leading, around which a bill has just been introduced to create a public catastrophe model, and that's drawing on experts across the UC system also. And that will take some time to do and will draw on a lot of the scientific and expertise and empirical expertise and modeling expertise of various experts across the UC system. So these are ways in which the UC system is and can continue to participate in this body of work.
But is there a coordinated effort throughout the university? It seems to me that every campus has an enormous amount of climate initiative focus, but I suspect that every campus also has an enormous amount of interest in fire per se. Do we have some support from UC system-wide to get you all together so that you're putting your heads together and coming up with policies that run the gamut?
Well, I can speak for Cal. We do have a coordinating mechanism that involves disseminating work that each of us is doing and drawing on the work of others. And folks are not shy about reaching out to other experts across the UC system. So I think that's happening informally in various ways across UC systems where experts in various areas are drawing upon one another and relying upon one another.
So President Trump says that our problems would be solved by better forestry management. Are you saying the same thing?
Well, what President Trump said was after a meeting with the Finnish Prime Minister that all we need to do is rake our forests. And I give him some credit because he was kind of in the right, zone. This is back in his prior administration, but it's more than raking. It involves a concerted and deliberate effort to mimic the way that nature used to manage our forests. And so, yes, that includes prescribed fire, hand thinning, mechanical thinning, trying to reduce the volume of fuel in the forest, not clear cutting, but a variety of approaches that are designed to try to reduce the fuel in the forest. Now, sadly, what President Trump is also doing at the same time is dismantling the Department of Interior, which has done a lot of work in this area, and dismantling the U.S. Forest Service and U.S. Park Service, which has done a lot of work in this area. So more of that burden is going to fall to states, as well as conservancy organizations like the Nature Conservancy, as well as counties and cities and towns, as we see an across-the-board retreat in this administration from spending money on anything related to the environment, nature, conservation, our public lands, with one exception, which is he's very keen on opening all of our public lands to more drilling and extraction of fossil fuels, which will take us in exactly the wrong direction if you want to try to keep insurance available. Basically, insurance is the climate crisis canary in the coal mine, and the canary is dying. And so you can do a number of things in the shorter midterm, importantly, to try to make insurance more available. One of those is more investments in adaptation and making sure the insurers account for that in their writing and pricing of insurance. That's important, right? But fundamentally, the background risk is going up because global temperatures are going up, because we're not doing enough fast enough to transition from fossil fuels. So where the president is going and where his administration is going is exactly in the opposite direction from where we need to go to try to make sure that we at least deaccelerate global temperature rise and make it possible for insurers to keep writing insurance in this country. One last note, just so that you understand the implications of this, though, across the board for financial markets and financial well-being and the real economy. The Federal Reserve Chair, Jerome Powell, testified before Congress about 3.5 weeks ago that he believes that there will be significant parts of this country where you won't be able to get a mortgage any longer. Why? Because all mortgage lenders require that you have insurance before they will write you a mortgage. And to the extent that insurance is unavailable or unaffordable, people will not be able to get mortgages. And so there's a flow through of risk and loss and consequence, climate change, catastrophic weather events, insurance pricing, mortgage lending, mortgage availability, housing markets, and then potentially implications for local governments that rely on property taxes and assessed values of property to be able to cover debt service. So then that has potential risks for municipal borrowing and for bonds issued by municipalities. So, this is not a good picture. And the direction of travel is a very bad one.
Well, that's cheerful.
I thought you'd be happy with that.
I wonder if there's some questions from the audience, and if we kind of if you could raise your hand, and we'll run some mics around as necessary.
Hi, I guess I would probably prefer the price of insurance to rise rather than for the insurance to become unavailable. And I imagine the insurance industry would argue that also, that there's a sort of a moral hazard in keeping prices artificially low. So I'm just wondering if there's been over-regulation of pricing in this industry, and what do you feel about that argument or that concern?
That's a great question. And yes, insurance prices have been rising, not just in this state, but nationally. In this state, on average, it's gone up about 60%, likely to go up even higher. And across the United States, insurance prices are going up dramatically. The argument of it by insurers is, if we would just not have insurance regulation, then everything would be fine and insurance would be available. The counter argument to that is that this problem of insurers writing less insurance and not writing new insurance is occurring in both rate regulated states and non-rate regulated states. So there's only about 16 states that regulate rates. The other, help me with my math here, 34 states and 6 territories allow insurers to charge whatever they want with no regulation. Even in those states where insurers are free to charge whatever they want, insurers are decreasing the rating of insurance and non-renewing. Why? Because even at the highest price that they can command, the losses are exceeding their ability to make profits at that price. And the best example of this is Florida. Florida has basically deregulated its insurance market. It has rates 4 times the national average. It has deregulated barriers of entry to be an insurer in Florida. It has created 2 taxpayer-funded reinsurance facilities, which is basically insurance for insurance companies. So instead of private insurers having to go out to the private market and buy reinsurance, they have taxpayer reinsurance. They've, about 2 years ago, limited all third-party lawsuits against insurance companies. There's a long list, a longer list than we have time for, but Florida's basically deregulated its insurance market. And yet, the national insurance companies are not writing any insurance in Florida. They've pulled out completely. And Florida's been reduced to regional and local insurance companies, which can charge basically whatever they want. But every 3 or 4 years, a hurricane lands, and even though they're charging as much as they can and want, 8 or 9 of them end up going insolvent because even that's not enough to cover the losses. So yes, more rate in the short or midterm is going to continue to be demanded by insurers, and they're going to get it, and they are getting it. But in the long run, we're not going to rate increase and deregulate our way out of this problem, because the risk and the magnitude of losses is exceeding what you can actually cover even at the highest prices. Now that's landing with different levels of acuity, and each state is at a different place in terms of that vector, but that's where things are going.
Roger, go ahead.
Yeah, a couple things. There are obviously lots of hazards and risks that we have, that exposures to loss in insurance. And certainly one of those is fire. There's also the question of hurricanes. Earthquakes is more complicated. It's somewhat insured separately. But what I'm curious about primarily is, what is the cost of the forestry that makes a difference? You talked about the rates of insurance, but I'm curious what the total cost is to society of going the method you're recommending, which sounds so reasonable to me, but I would like to know what other costs there might be as well.
Yeah, no. Well, the estimate is that we would need to invest about $5 billion annually for the next 10 years to substantially reduce severe wildfire risk in California forests, right? So I don't know, 10 times 5 is $50 billion. The losses in the LA wildfire alone, insured losses now, are projected to be 45 billion, right? One event. And that was in January. We could have 2 or 3 more of those in other places in California. So, I think it's not inexpensive to make the investment in forest treatment, but I think the cost benefit is positive in terms of avoided losses. And those are just insured losses. Like the LA wildfires are 45 billion in insured losses. The economic losses, by some projections, I think UCLA came out with a number of like 240 billion in economic losses. So 50 billion over 10 years versus 240 billion in economic losses from one wildfire event. And we could have 3 or 4 of those, or maybe 10 or 15 of those in the next 10 years. I think it's a good investment. It's a great question, but I think it's a good investment.
Do we know how many faculty, staff, students at UC were affected by the Los Angeles fires and Pasadena fires?
I don't.
Anybody here? No.
Just from me emailing in my bi-monthly newsletter for faculty and retirees to reach out to me if they had questions or concerns or needed resources, I got about 28 retired folks. Those who were on active recall were able to get some kind of resources from the chancellor and the vice chancellor of academic personnel. So they were not on, those who were not on recall or a retiree, 28 people reached out to me to get them connected to resources. But that's a small number compared to those who were active staff or active faculty that were affected by the fires.
Do you know, Cheryl, by any chance?
I was just looking, I do have a number. UCLA and campus and UCLA Medical Center was hit the hardest, and I just don't remember the number off the top of my head, but I could probably find it in my material. We did have first time we had a system-wide effort where people could, we had a system-wide effort where people could contribute time for those that needed additional time to take off. Typically that's done at a local level, but from a system-wide level, we enacted a policy that allows people to take additional time off from their coworkers who donate time. But I don't have but it was a large number at UCLA. It was like a number when I read it, I'm like, oh, that's a lot of people who are displaced looking for homes and trying to work at the same time. I can look it up though, okay?
Thank you. Oh, great. Caroline, go ahead.
So thank you very much for coming and talking to us, Mr. Jones. And my question has to do with the current administration and its disdain of climate change, and wondering about the threat to your research and all research on how climate change may affect a lot of Americans. But the question isn't about that. The question is, do the insurance companies understand what's at risk if your type of research is cut off at the knees? And are the insurance companies mobilizing in a coordinated way to try and pressure the administration about their attitude?
They are not. And this requires a little bit of explanation. So one, yes, they are very sophisticated and uniquely positioned to understand what's happening globally with regard to increased losses due to climate change. Now, part of the problem also is we're shoving more people and businesses into harm's way, and also the cost of replacing property has gone up too, right? But those two last things wouldn't matter as much if we didn't have more catastrophic events landing where we're putting more people and businesses, and we didn't have, I mean, the replacement cost wouldn't matter as much if we didn't have more of these catastrophic events. So they understand, and the global reinsurers understand as well, because they're seeing their losses go up too. However, this requires a little explanation, but most U.S. insurance companies are headquartered in conservative states for tax purposes. And in those conservative states, the last thing the governor or the appointed insurance commissioner wants in these conservative states, whose leadership don't believe in climate change themselves, is having an insurance company executive talking about climate change or doing anything from a policy or legislative standpoint about it. So U.S. insurers are not engaged in any of the efforts to try to reduce greenhouse gas emissions or adopt policies or legislation related thereto, let alone get involved in supporting or defending against the administration's effort to cut the heart out of universities and colleges across this country. So they don't engage on that. They don't get in the middle of that, and they basically just kind of focus more narrowly on insurance legislation and insurance regulation.
Is there anything that we as retirees can do to push them?
Well, I mean, I think in your own capacity as insurance consumers, you can certainly ask your insurance agent and insurance company, gee, is your company taking into account home hardening, defensible space, community mitigation, landscape mitigation? The answer is going to be no, and they're probably not going to change because you asked them. But having more people raise this issue, I think, is powerful. I think through your association, sort of elevating work across UC campuses around climate change, climate risk, financial institutions, financial risk is helpful. And I think supporting legislation at the state level that's designed to try to address this as well. So I mentioned this bill in Colorado that passed this year that requires the insurance companies there in their modeling to account for empirically proven, scientifically based adaptation and resilience measures. Supporting a bill like that here in this state would make a big difference too. So those are some ways that you as individuals or as an association could help move the dial in this area.
Thank you.
So Dave, do you have time for one last question?
I do.
Okay, Ken, take it away.
Yeah, thank you for a very interesting talk. I have just one probably short question. I agree with all the mitigation, and this is very important, but it's clear that this is a national emergency, and it's clear that the insurance companies, some for justifiable reasons and some perhaps for not, are not meeting this crisis. Are we moving towards what we might have to have as a national insurance program? Well, I realize it isn't going to happen under this administration, but looking forward, is this going to be really one of the solutions, that this is going to have to be something provided at the very lowest level by the state, but perhaps by the federal government?
Maybe. Although I have a lot of reservations about national insurance schemes, because the ones we have done tend to be regressive, heavily taxpayer subsidized, and aren't risk rated and send the wrong signal about risk. So I'm thinking about the federal crop insurance program, whose rates don't really reflect the risk that farmers face, and it's basically a huge taxpayer subsidized program for ag, which is terrific for ag, but maybe not so great for the rest of us. And then the National Flood Insurance Program. So the private insurers got out of covering flood risk probably 50 or 60 years ago. Congress created the National Flood Insurance Program. Until very recently, its rates have not been risk adjusted. So it's been sending the wrong signal about risk and encouraging more real estate development in areas that are prone to flooding, whether it's river flooding or coastal flooding. It's regressive. You know, the 45% of us that are renters are paying through our federal taxes to subsidize a flood home insurance product for the 55% of us that are homeowners. And every 10 years or so, Congress has to shovel 10 or $15 billion into it because it's not collecting enough money to cover its actual outflows. So I have a lot of skepticism about national schemes. I think it's possible we may end up needing to be there. What I'd rather see happen is that we make investments in adaptation and resilience, that the private insurers account for those in their modeling and make insurance more available. I also think there's something else insurers could do, which is stop insuring and stop investing in fossil fuels. Not overnight, you know, some meaningful transition over some period of time, but insurers collectively have over $500 billion invested in fossil fuels, which raises an interesting question. Why are they invested in the very industry whose emissions are posing an existential threat to their writing of insurance due to more extreme and severe weather-related events that are only going to get worse? So there are things that states could do. States could require insurance companies to stop writing insurance for and stop investing in fossil fuels, not overnight, you know, some transition period that would be reasonable. So these are all things that, and then 35 states have these insurers of last resort called FAIR plans. They're not state agencies. They're not taxpayer funded. They're state statutorily created private associations of the insurance companies writing in the state, and they write insurance for the stuff the private insurers won't write for. So shoring up the FAIR plans as more people are pushed onto the FAIR plans. A federal reinsurance program of nonprofit reinsurance for FAIR plans. Federal premium subsidy program for individuals buying insurance on the FAIR plan, much as we did with the Affordable Care Act and the health benefit exchanges, and a federal tax credit that basically defrays the cost of a premium if you're an individual or family, means tested, low income, buying insurance in a health benefit exchange. Those are some things short of a national scheme of all risk, all disaster insurance that I would suggest we ought to try first before we go to a national scheme of insurance, which could also result in supplanting whatever's left of the private market. So my view is work with the private market, try to shore up the state-based FAIR plans, which are an alternative private market, federal assistance for those before we stand up another national scheme of insurance. At least that's my thinking at this point.
A lot of thinking indeed. Thank you very much for joining us. Really appreciated your comments.
Well, you've been very kind. This is the point of the meeting where people run screaming from the room and ask me to stop talking about insurance. So thank you very much for your kind attention. And thank you for all of your service to students and to graduate students and to researchers. And thank you for your own research. And thank you for those of you that are administrators. Thank you for leading what I believe is the best public university system in the country and the world. And thank you for continuing to gather in these two fora as continued leaders and experts, academicians, and terrific leaders in the academy. Thanks again.
Thank you.
Okay, we're going to give you a longer break. We're scheduled for a 15-minute break. Why don't we make it 10 minutes since we already gave you 4? So 10 minutes. So we'll get back. Let's see, what time is it? 1:50. Okay? All right.
Snacks in the back.